What exactly can we expect to see in this marketplace, given the fact that we just don't appear to be going anywhere above this 2,800 to 2,815 level in the S&P 500?
Great, Dominic. Great to be here. So in terms of kind of what we're seeing out there today, right now, I think it's just going to be more of the same in terms of kind of where the markets go from here. You've clearly seen the Fed at a place where they don't necessarily need to take any type of policy action at this point. In fact, we see it in terms of they've actually taken quite a bit of a U-turn since the fourth quarter of last year. And so I think, where market participants are at this point are really trying to focus on the fundamentals of underlying companies, as well as to find areas or pockets of opportunities that represent reasonable growth, also for accounting for valuation considerations.
So where are those places then? Because it seems like the perfect recipe, growth at a reasonable price, valuations that are there, potential upside. Those are all things that I, as an investor, would want. So where are you finding those opportunities?
Great question. So in terms of, from a sector standpoint, two areas that we currently are actually overweight in our portfolios are actually energy as well as real estate. Both clearly have lagged over the last year or so in terms of relative market performance. But when you think about kind of where we are in terms of the cycle, energy companies have definitely spent more of their time in terms of reinvesting in their businesses to drive down costs associated with their businesses. And when you think about real estate, despite the fact that we have seen some regional weakness in places like New York and San Francisco, you also have to still take into account that relatively low interest rates are still a good driving factor for housing affordability going forward.
Okay, that's the bullish case. Home builders, real estate, energy, we can kind of see the thesis there. Where exactly then would you stay away from? Which parts of the market do you think are the ones investors really need to just keep away from right now, given the fact that the markets are where they are?
Yeah, so in terms of kind of, we're not necessarily thinking about it from a sector standpoint, but rather in terms of just, what are the type of companies that really kind of represent, some, headwinds in terms of kind of where the market's likely to go. And I think for us, we really kind of see that more in the way of more momentum-oriented stocks, stocks that, clearly, did benefit in terms of the rally over the last couple of years, but may not necessarily represent the best opportunities in terms of kind of growth going forward. And so, we tend to actually like owning more higher quality names, but also, companies that really trade at more reasonable discounts relative towards the market, and really kind of have a better prospect in terms of sustainable growth going forward.
There's always a bull-bear debate out there, so not everything is with rose-colored glasses. What exactly is the downside risk, and what could drive it in your mind?
Yeah, so, I think a lot of people are probably focused a little bit more in terms of kind of what's been the ongoing negotiations between the United States and China in terms of the trade war. But we actually see, in terms of kind of how market participants are looking at this, really in terms of the Fed and what the Fed is likely to do to be more accommodative in terms of policy going forward as being a key risk out there. I think, for where they are at this point, they have taken a lot of steps to try to be a little bit more accommodative without necessarily signaling that rates could move lower in the future. But I think, if they do continue to necessarily kind of project kind of more the idea that rates could potentially go higher, I think you could probably see another similar scenario to like what we saw back in November.
All right, you mentioned rates, so I'm not going to let you off the hook here. Where are rates going, and how exactly do you position for that?
Yeah, so, I think in terms of kind of how we've thought about positioning, we actually see rates remaining a little bit more range bound. Clearly, the 10-year Treasury yield at the near the end of or November last year was roughly around 3.25. Currently today, a little bit more range bound around the 270 range. But I think if you are an investor considering towards positioning towards rates, it doesn't necessarily hurt to move out a little bit further in terms of the belly of the curve. You kind of think about kind of what's the best case scenario for you. You're going to be able to clip the coupon, and really kind of the worst case scenario, if rates were to move up in terms of kind of some unexpected amount of inflation coming into play, you're not necessarily getting hit as much in terms of the overall punishment from rates.